Welcome to Market Matters presented by MyX. I'm Joe Tigay with Brian Stutland. Last week, we told you how critical NVIDIA was going to be to this market. They did not disappoint, sending stocks to all-time highs. But meanwhile, money market funds, assets are just exploding. They continue to rise and rise and rise. How is this possible, Brian?
Yeah, I mean, look at that chart. How much money is flowing into this cash, just safety haven trade? And yet we have stocks like you mentioned, NVIDIA flying. Well, we saw an article come out here on Bloomberg. It's kind of interesting. Basically, corporations, right? They're getting paid over 5% now to just keep their money in cash. That's well above the CPI number, inflation numbers, and they probably just feel comfortable. In the 2010s decade, they felt good about buying back stock because they could borrow money very cheaply and then buy back their own stock, grow their earnings that way. Now corporations are keeping that money in cash, about $4 trillion of that, so to speak, in corporate cash, safety trade. But retail investors also doing that. So, this $6 trillion, it's either got to, stay hidden and probably take the market lower, or it's going to flow into this market and the market still has more legs to the upside. I think we have some interesting stats on it. We'll get into that later in the show. I really want to dial down and talk about what this all means because this is really an interesting phenomenon that we haven't really seen in over a decade, maybe 2 decades since we've kind of seen this type of action in the market. So much money sitting in money market funds. So Joe, I'd love to get into it, but what else do we have on tap this week?
Yeah, some interesting things already there. But yeah, we got a lot of reports this week. It is going to be a busy week. The big thing I'm looking forward to is the PCE. That's the Fed's favorite, the so-called Fed's favorite inflation number. I think that's going to be something that might shift expectations.
Yeah, that really will have an effect on people's inflationary speak. And then take a look at this, obviously that sentiment indicator that we like to look at for the markets. We really hit that all-time 52-week high on the bearish indicator back in November of last year. And that was really a time when the interest rates then plummeted a lot lower. So we've talked about this interest rate, this phenomenon of moving into money markets. Well, when rates dropped, all of a sudden people became, we're already bearish at that point. Then rates dropped and people flooded into the market and it drove it to, new all-time highs.
Yeah, so this indicator is kind of neutral to bullish. This one is a little bit too bullish. Brian, what do you think is happening here in the Fear and Greed Index?
Well, we saw basically volatility get sucked out of this market last week after NVIDIA earnings. Basically, the semiconductors, the AMDs of the world, NVIDIAs of the world, the Mag 7 all drove the market higher and volatility collapsed. So the VIX and the Spikes Index are sitting, basically in this low teens area now. And so that to me is a little bit of a frothy, overbought market condition.
Yeah, we mentioned this last week that if the one thing holding this index down was that volatility index. Interesting to me, though, we still have the spike index above 14. It still seems like that uptrend could still be intact with these stocks at these all-time highs. And again, we'll be following this chart. Make sure to follow every week, 1 o'clock Eastern. Tune in. Don't forget. We also usually talk about this interest rate expectations. This has been shifting the markets coming back to where the Fed was. We talked about how they lacked credibility. They've been saying that they've had be higher for longer. The market didn't believe them. Finally, the market is coming along. Right now, we're basically at no cut in March. It is about no cut in May and maybe 65% cut come June.
Yeah. And, obviously where those rates go, really this, you look at the 10-year yield here, could that be a head and shoulders topping pattern where it goes lower, starting to form? Yes. But it also could be basically at the low end of an upward channel. So, this PCE number coming up, this week is going to be big because it's going to give an indication whether inflation is starting to get under control, or are we back in the mid 70s, Joe? And, maybe inflation's a tough thing to control.
After that hot CPI, I mean, it just felt like interest rates were so high and they were soaring higher. But you look at this 10-year yield, we're really kind of well off of where we were the third quarter of last year. So that November reading of like super bearishness, we're still kind of away from that. Interest rates have not quite gotten there. On the shorter term, it's a lot closer. We're a lot closer to where we were back in September. And when we've gotten to this area, we've gotten up to 5%. Things have certainly broken. And if you kind of pull the S&P 500 over this, Brian, we want to look at this. You can kind of see we've had a few instances when we had rising interest rates and rising markets. And then suddenly something breaks and it all comes down. We've seen a few pullbacks after those rising interest rates, rising markets. We're in one of those situations right now. Is something going to break? We'll wait and see.
Yeah, I mean, the 5%, and this really kind of gets into the big story of the week here that we like to cover. We talked about this at the top of the show. Money market funds flowing into those right now. The 2-year note, obviously an indicator. 5% is an area I think we want to watch, whether to see if this market would break or continue to move to make all-time highs. But this money market flow is something that can be a little concerning, right? Because, Joe, if you look at it, it seems like going back historically is every time there's this big shoot up move into money market rates, if inflation stays below those rates, what we have found is that can make a bit of a tipping point for the markets because money just doesn't flow into investable risky assets. And what happens is you lose liquidity in those types of things and you lose innovation. Now, obviously, AI is driving innovation right now, and that's what's driving the market higher. Clearly, we saw that from NVIDIA earnings, but that is something that is definitely to be concerning here as we get this shoot up in rates because we've historically gotten a pullback of significant amount, 10 to 20% pullbacks in the market when we see this, huge move up in money market funds.
Yeah, I mean, was there something that corporations knew? Was there something out there in 2007 when people was pulling out of cash or pulling out of stocks and piling into cash? It sure seems like this was in the lead up. Now, you may say, "Oh, well, there's just a mountain of cash on the sidelines. This is gonna keep stocks high." Well, we'll wait and see. We have some more charts on that in the future. But yeah, this is fascinating, Brian. Just take a look at this. Look at how high off of the trend line, the baseline that corporations' cash positions have gotten.
Yeah, actually that started before 2020 COVID. Actually, that started in 2019. We saw this buildup in cash, and you got this feeling that maybe we were in this environment where inflation wasn't going to be able to remain as tame as it had the decade prior to that. And more corporations, instead of just continually to buy back the market with their money, they were putting it and stockpiling it. Did they know maybe COVID was around the corner? I don't know. Us, Joe, we're option traders by heart and market makers. So if you're talking to any option trader, there's a skepticism, right?
But then COVID came and a flood of money came into the market. And so the corporations right now, I think they're just not sure what to do with it. The money's still there. It hasn't been spent essentially. It's still there. Corporations can't quite figure out what to do.
Yeah. And I think when we look at this, we should probably dial this down back even further. Is if you look at what's the risk adjusted return for me, if I'm going to stay in the cash, what am I missing out on? And historically, Joe, we've seen, this is a good chart here because this is a ratio basically of the rate of return of the S&P versus the rate of return that a bond would pay you, right? So if let's say S&P is returning 8% and interest rates are only 1%, that's an 8-to-1 ratio. To me, I have a lot of risk when I buy stocks. But there I want to be invested in the stock market because they are paying me a lot to take on that risk. Now we're seeing that backtrack. You're not getting paid a whole lot to take on the additional risk of interest rates. So Joe, what do we do for our strategies? What does that mean for an investor? Is there a better way to be invested? Because obviously, even 3% difference, let's say S&P returns 8, a money market returns 5%. That 3% difference over a long period of time is a big difference, isn't it?
Yeah. And, even at 5%, like you said, which is, something we haven't seen in 20 years. So the risk-free rate right now is 5%. Even at that level, I do expect stocks to outperform that over time. Now, that said, given that risk right now, it just seems like it's at a pivot, at inflection point. At some point, this is going to turn around and people are going to say, I don't want that risk. I'm going to pile into bonds. I still want to be in stocks. I still want to hold that risk because I know over the long haul, stocks are going to outperform that 5%. So I like doing it with a hedge, having protection on staying in stocks, staying in some growth names, staying in that long-term rate of return, which I expect to exceed 5%, yet having that hedge on, limiting my downside, using an active management approach to take advantage of some of the volatility swings.
Yeah, and I think this is why the Spikes Index or the VIX Index is probably going to have a struggling time to get to down, let's say 10. I mean, it's in the 13, 14 handle range right now. It's going to probably struggle to get to 10 because the institutional traders out there understand this differential risk premium, but they still want to be invested in the stock market. So what do? They buy options, they buy premium, which keeps sort of a base level. That's probably why we're really seeing volatility indices move higher when the market's moving higher at this point, because people need to stay hedged. Whether you trade a long short strategy, we're seeing money flow into there. Whether you're trying to trade a hedged equity strategy, that's what we try and employ for clients, because I think you've got to take some of the risk out of owning stocks, but also still capture the rate of return and the risk additional premium you get paid to own the stock market. So it still makes sense to be in the stock market, just in a hedged fashion. And, being an active trader, like you mentioned, Joe, is probably a way to play it. And again, this is probably why we're seeing volatility bid up and indices that track option premium stay elevated.
Yeah, and just because this is, we're surpassing, the Great Recession areas, it doesn't mean this needs to turn around on a dime right now. Obviously, the dot-com eras were a little bit riskier for stocks. I mentioned before, we were talking about just this cash and inflation, why maybe all this money on the sidelines means that people are going to flood into stocks. Well, maybe not so fast, just because it's actually paying you money to earn cash. Now, over the past 20 years, that's actually been not the case. Usually the rate of inflation is higher than the yield on the risk-free rate. But right now we're in one of those rare circumstances right here where our cash is actually appreciating in value. We had a brief one right here in 2019, and of course a brief one in 2007.
Well, you bring it 2019, 2007, then going back even further there, it's looking like 2000. I mean, the market took a significant dive every single time once you got a longer period of time where inflation remained below the Fed funds rate and the real rate of interest rate return was a lot higher. That is definitely a warning sign I'm looking at and could be one to concern. And again, another reason why people are owning volatility, owning options right now, because, if there's a sharp downturn in the market, that protection is going to pay off.
Yeah. We talk about these concerns all the time. That doesn't mean that we're expecting like an imminent pullback in the market. That doesn't mean we're expecting something imminent to happen. We're just talking about what we've seen in the past, what we're prepared for always. Now, remember, we are always expecting the market to go higher because that's our base position. We just want to be protected in case of a pullback. We're bringing this back up. We're still in that spot. We still have higher lows here in the spike index. We're still getting these higher implied volatilities. We'll see what happens in March next week if we just had a blow off top with this NVIDIA, or we're going to buck the trend because we've had a really good start to the year, a good December, a good January, a good February. That usually bodes well for the market. We might buck the trend this year and not get that higher volatility, but we'll wait and see. We're prepared for it just in case.
Yeah, sure are. So, I mean, I think also on the week, we have some interesting earnings coming up as well here on the earnings report. Take a look at this. This is kind of interesting. The implied move levels of some of these stocks are very elevated relative to what you would normally see going into an earnings event. Yes, options typically get bid up when there's an earnings event coming up because people want to either own a call or a put for the big move. But these are somewhat elevated. Any of those names kind of interest to you, Joe, that people should be looking at specifically?
I'm watching Snowflake on
Okay.
Wednesday. I think that's going to be an interesting one. Another one of those cybersecurity names, which I think is kind of critical to the current market. You got anything on your eyes?
Yeah, I mean, Palo Alto Networks obviously took a big dive after it reported and kind of guided lower a little bit ahead of times. But that stock I think is at an interesting level to buy now. It kind of got ahead of itself, I think, a little bit. It had a pullback. Snowflake is similar, cybersecurity, networking kind of plays. So I could see why, to me, the implied move to me should be trading higher than its normal historical post earnings move. I'd be a little worried that there's going to be a decent sized move ahead of the earnings for that.
All right, well, stay tuned to the end of the show. We will be talking more about implied volatility and options 101, but let's move it on to the trade ideas for the week. Brian, here's one of the big names out there, one of the big Mag 7, which maybe is falling out of the Mag 7. Tell me what you're seeing with Tesla.
Yeah, Tesla's kind of interesting because the stock is up, over 4%, or at least it was a little bit ago. It's making a decent move off the lows we saw just recently. And, those lows were made. The stock got driven down when Musk basically came out and said he wants to either own more of the company, given more shares of stock. Otherwise, he's taking his AI play within Tesla and all the automation, full self-driving stuff out of the company, threatening that he wanted to get paid more, yada, yada. Either way, the stock started tanking. But now, look at this chart. Okay, so maybe we're still in this downtrend chart for Tesla and it needs some sort of valuation repricing. But it kind of made this triple top where it's been making successive lower highs. And it broke down below a critical level of 197 and kind of stayed below there. Now, typically what you'd see is a retest back, breaking that sort of, support now becomes resistance kind of thing. And so we got back to 200 on the stock, but today it's been cracking through that 197 low level, staying above 200. So I think if we get a couple closes here above 200, that upper end of the channel, this down channel, even if it is a down channel, could be in the cards up above that 220 level. So I want to use an option trade to play that. We talked about an options 101 last week. Very simple, buying a call, what that means. So I'm looking to buy a call in Tesla right now. I want to limit some of my risk because maybe this is just a retest of that support resistance line, but maybe this is a breakout back to the upside. And when we get in that break points, I like owning a call here, specifically the April 220 call. I can pay about $8 for that with the stock just above $200 a share. So now all I'm risking is $8. My break even, I need the stock to get above 228. So the stock would need to push towards that high end of the channel at 240. If the stock moves higher, I might then reposition, sell another call against it. I don't necessarily need to just buy and hold this call all the way to expiration. I'm using this call to sort of trade around a position. But for now, I think this is the right play. Limit my risk, but still get, upside here.
Yeah, it makes a lot of sense to me. So you're kind of looking at right about here for your break even. You're really looking at a nice move to the upside, but a relatively cheaper way to get into the name. This is a stock that was 280 just back last year. So there's lots of risk to the downside potentially. Still trades at a very high multiple. So to me, this looks like a reasonable risk reward. Now, what would you do, Brian, if let's say we do get your dream scenario and the stock by April is trading near the higher end of this channel? We get something, whatever like that. What would you do at that point?
I would probably look to maybe sell at the 240 strike call or the 250 strike call. That's just at the top end of that channel, maybe just outside, looking for that option, that particular option, at least to expire worthless and collect some premium and lower the cost that I initially paid, that $8 for that 220 call. So that's what I meant by kind of trading around it, is I'm going to look to sell another option in anticipation that I'm going to be getting long stock and then start to almost buy right my position.
Yeah, that makes a lot of sense to me. Now we're kind of in this spot in the market where we've seen for a while now we're getting rising markets, rising volatility. That trend seemingly is still intact. So I think an upside call makes a lot of sense in that environment.
Yeah, and then I might just fully reposition and really get bullish if the stock gets above 250, because you mentioned that 280 level being the all-time high. A lot of the Mag 7 trading at all-time highs. Tesla is one that is not. So, could it break this downtrend and then all of a sudden move higher? Yeah, that could be a significant threat. But the EV market is becoming more and more competitive. And so, there might be that pressure where the high end of the channel sort of holds intact.
I think they might just throw the Magnificent 7 out and just say it's just NVIDIA now.
Yeah. There's still, I think, you know what, Joe, I still think, an Amazon, Microsoft, those kind of names that give you cloud computing with the AI play can go through it. But what they say about the gold rush, the people that got the richest sold the picks and picks to mining gold.
Levi jeans, right?
Yeah,
that started in the gold rush. So yeah, so it wasn't the gold miners; it was people supplying the miners.
Yes, and that is NVIDIA. NVIDIA is that to AI for sure.
Now, that said, I do think Apple has the potential, Facebook has potential, Microsoft has potential. They actually might own the gold, and the gold being the data this time. So that they might have some intrinsic value there. We'll see how that plays out. It kind of, in 1997, 1996, this dot-com bubble was starting to happen. People didn't fully understand the internet, fully understand how it would play out 10, 15 years later. We saw this craze. I think we're kind of in that spot right now where people don't fully understand AI. I mean, we see it every day. We're kind of like ahead of the curve. But I think the average person in America, it's not really, in the front of their mind. They don't really see it every day. I think we're at the very early stages of this craze.
Well, yeah, I mean, and that's why, we're trading the NASDAQ 100 and owning that, but keeping a hedge on, right? So we want to get exposure to that for our clients, for myself. So I think that's still in play. That's the paradigm that we're in, and it should be an interesting trade and something to watch over the coming months. All right, so we've had a great show so far. On to our options 101. We wanted to talk to you about what is implied volatility. So Joe, can you give us a little lesson what implied volatility means?
Yeah, so very simply, implied volatility is the expected movement over the duration of the option. Now, there's a fancy calculus to figure this all out. Don't worry, the computer will do it for you. But there are 5 critical components that go into making an option price. That is, of course, the underlying asset price, the option strike, the time to expiration, and the risk-free interest rate. Now, we know those 4. The 5th one, we don't know what it will be, and that is the volatility that option will experience over the course of its life. Now, that is called the implied volatility because that option's price is basically dependent on what the market is saying the movement will be of that stock. Now, think of it like this. Stock traders, they buy and sell stocks based on, which are live bets based on where the stock will go in the future. Will it go higher or lower? Now, option traders buy and sell options, which are live bets on how the actual realized volatility will live up to the implied volatility they traded. So remember, implied volatility is all about the expectations of the movement. High volatility means investors think something might happen. There might be some event that'll cause the current stock price to move violently.
Okay, well, that just about does it. I know the word volatility can make people's heads spin. Don't be afraid to rewatch our Options 101 a couple times over. Believe me, I read the options book, the main one, literally about 5 times over when I first started trading on the floor. So don't be afraid to try and retrain your brain over and over again, because that's how you get better at things. But it's been a great show, Joe. Here we are, Trader Hub. Thank you to them and the sponsorship of the MyX on this show, Market Matters. Make sure you tune in every week. Mondays, 1 p.m. Eastern time. We'll have more with you next week. Update our trade maybe on Tesla to see where that moves. It's been a great show with me, Brian Stutland here, Equity Armor Investments, and my colleague, Joe Tigay.
We'll see you next week.